Hi, this is Brian at Leelyn Smith with the second quarter 2022 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, well, we're covering inflation today as it's been all over the news. And it's a very important topic to understand. It's one of the most important aspects of a smooth running economy. Too low of inflation means growth doesn't happen and people are employed, and too high of inflation means things are too expensive, business activity stalls, and businesses may fail. So we're going to cover inflation along with its causes and measures. And we're also going to talk about how to deal with inflation. So inflation is a general loss of purchasing power. Things get more expensive. You've probably already noticed this at the gas station or maybe at a restaurant. That happens when there are too many dollars chasing the same amount of goods, or, and this is important, there are supply shortages. So remember, we're post-COVID right now. We're still coming out of COVID. We're pretty much out of it, but we're still coming out of COVID. The government provided stimulus packages and the Federal Reserve increased the money supply. In addition, we had COVID caused supply chain issues. So you add them up, you have more money chasing the same amount of dollars and you have supply chain issues. That leads to inflation. Now, there are a couple of different ways of measuring inflation. One that you hear about in the media more is a more popular style, and it's called the CPI, or the Consumer Price Index. That measures, out-of-pocket expenses and tends to be a little more volatile. There's another way of measuring inflation that's called the PCE, and this is what the Federal Reserve uses to measure inflation. And this one, it covers out-of-pocket costs, but it also includes things that are not so out-of-pocket, like health coverage, for example, and it tends to be a little less volatile and therefore a little bit more reliable to use. We follow the PCE and the CPI, but mainly the PCE because the Federal Reserve uses that as their main indicator for inflation. Now, how to deal with inflation. Inflation in itself isn't all bad. Some is wanted. And remember, the Federal Reserve has a dual mandate of 4% employment and 2% annual inflation. You want some inflation. It's a sign of a healthy economy. You just don't want inflation to get out of control. And it's the rate of inflation that's more important. And right now we have a high rate of inflation. So in order to deal with inflation, the Federal Reserve uses interest rates as its main weapon to influence the economy. So know this, inflation and interest rates are joined at the hip. As inflation increases, interest rates will be increased. As inflation is low or decreases, interest rates will be decreased. So the idea of interest rates and inflation being joined at the hip is a very useful one to understand where the Federal Reserve may be heading. Now, what's important to consider is the rate of economic growth. A high rate is unsustainable, hence inflation and interest rate increases, but we want some economic growth. Now, one thing to note, the financial media has been reporting a lot on something called a yield curve and the inverted yield curve. A yield curve is just a plot of short-term and long-term Treasury bond yields and what their rates are. It has been a decent indicator in the past of recessions, but it is not causal of recessions. It's just correlated to it. And honestly, there's much more analysis that need to be done on the business cycle rather than just looking at a plot of Treasury yields. So take that with a grain of salt anytime you hear about an inverted yield curve. Now, it's possible that the Federal Reserve accomplishes a soft landing, meaning that they increase interest rates enough to tame inflation, but we don't enter a recessionary period. At the moment, the economy looks relatively robust and strong and resilient, but the impact of these rates is yet to be seen. In the meantime, keep the long term in mind, as this is just a period of rising interest rates, and this isn't going to last forever. And ignore the short term noise, whether that be about the inverted yield curve in the media or the short term market movement that we see right now. Okay, that's it for this time. Remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible and keep an eye out for our next quarter update. Thanks for watching.